Welcome to Jester Financial Technologies presentation, The Rules of Retirement Have Changed. There are four distinct rule changes that the federal government has been extremely transparent about. Unfortunately, the financial industry has yet to start addressing them, though. The first rule, Rule 1. You have a mandatory expense in retirement. Believe it or not, you have to have one thing in retirement, and if you do not have it, you will face monetary consequences. That is, you have to have health care coverage. Believe it or not, with the Affordable Care Act, everyone must have credible health insurance. But keep in mind that Social Security also states that in order to collect benefits, you must accept Medicare Part A when eligible. Since 1993, with a change to the Program Operations Manual system, better known as POMS, you must accept Medicare Part A or forfeit all Social Security benefits. That means all current, future, and past benefits. Please keep in mind that Medicare also has other parts, and those other parts have a late enrollment penalty, which means Medicare Parts B and Part D. When you are eligible for Medicare, you have to enroll or you will face a 10% penalty for every 12-month cycle missed for Medicare Part B and a 1% penalty for every month missed for Medicare Part D. Please keep in mind that these penalties are compounding and they do last throughout the rest of your retirement. You have to enroll into Medicare or you're going to lose your Social Security benefits and you're going to face possible late enrollment penalties that will follow you for the rest of your life. Rule 2. Your only mandatory cost, which is your health care, is determined by your income. Believe it or not, Medicare is means tested, meaning the more income you make in retirement, the more you're going to pay for your health care coverage. This is something the financial industry is yet to start talking about. Due to the income-related monthly adjustment amount, which was created under the Medicare Modernization Act of 2003 and then extended through the Affordable Care Act in 2010, Medicare Parts B and Part D are based on how much income you're earning. If you are earning too much income, you will face extra charges or surcharges due to having that higher income. Rule 3, the income that they're going to be using is almost everything that you've saved for your retirement. Believe it or not, the definition of income per order of Social Security is your adjusted gross income plus any tax-exempt interest or everything on lines 37 and 8B of the IRS Form 1040. Some examples of income: Social Security, any wage, pension, income, rental income, capital gains from the sale of your home, any dividends including municipalities, annuities, 401k, traditional IRAs, 403b, 457, SEP IRAs. Ultimately, anything that you have saved in a tax deferral way is going to be used against you when you decide to tap those assets later on in retirement. And for those of you that have done it using a traditional form of IRA or traditional form of 401k, please keep in mind that at the age of 70 and a half, you have to start taking money out. What's not income? Well, qualified distributions from Roth accounts and health savings accounts, as well as qualified distributions from 401h plans, very specific annuities like single premium immediate annuities, as well as deferred immediate annuities, as long as they are non-qualified. You can tap the home equity out of your home through a reverse mortgage, and that will not count. And finally, certain types of life insurance, like whole life insurance and index universal life insurance. They're fantastic because you can also place a rider for long-term care on it as well. Rule 4. The bulk of your health care costs will be deducted from your Social Security benefit. Ultimately, you will be paying for your health coverage through your Social Security check. According to Social Security, the average Social Security benefit in 2013 was $15,528 annually. The maximum cost of living adjustment going forward at the most is going to be 2.8%. This is according to the Social Security Board of Trustees. And why this will impact most people is that 50% of retirees depend on Social Security to be more than 50% of their entire income. As you can see from this slide, the impact of health on the average retiree Social Security benefit will be drastic. In blue is the Social Security benefit. As you can see, it starts at $15,528, and it's going to adjust or inflate by that 2.8%. While in red, that is your total Medicare cost. And those Medicare costs start at roughly $4,000 a year, and they are going to inflate by roughly 7% because that is what the average Medicare inflation rate has been. So in green is your actual take-home income. As you can see, your income is never going to increase. Not only is it never going to increase, you're going to see that you're going to most likely be taxed on the income that you've never received. Once again, this is something that the financial industry has yet to start talking about. No one is helping you plan for the high cost of healthcare costs that you're going to face in retirement. Unfortunately, less than 8% of Americans have ever planned for any healthcare costs in any financial plan, let alone their retirement plan. And ultimately, your greatest asset that you're going to have, especially in retirement, is your health. We at Jester Financial Technologies like to ask everyone one simple question. Isn't it time you started to plan for it? For more information or for a free healthcare report, please feel free to visit us at www.yourretirementcosts.org. I'd like to thank you for your time and look forward to hearing.